Hey everyone, welcome back to our channel. If you're looking to build wealth and make smart investments, you've come to the right place. Today, we're diving into one of the most time-tested and reliable strategies for building wealth, value investing. This is the strategy that has made legends like Warren Buffett, Charlie Munger, and John Templeton incredibly successful. So, what exactly is value investing, and why do so many experts swear by it? Stick around to find out. Before we begin, don't forget to subscribe to the channel and hit the notification bell, so that you're the first to know when we release a new video. Now let's get started. Value investing is all about finding stocks that are selling for much less than their intrinsic value. In other words, you're hunting for a bargain, buying stocks that the market has undervalued. The difference between the stock's market price and what you believe it's actually worth is known as your margin of safety. This approach was developed in the 1920s by professors Benjamin Graham and David Dodd at Columbia Business School. They shared their insights in the classic book titled Security Analysis, which still remains the ultimate guide for value investors nearly 90 years later. This book laid out the principles of analyzing and valuing companies based on fundamentals, a strategy that has stood the test of time. You might have heard some say, value investing is dead. Is that true? Well, here's the thing. Value investing isn't a get-rich-quick scheme. It's a long-term strategy, often involving holding stocks for 10 to 20 years, or even longer. Studies have shown that value stocks generally outperform the market over the long term. For example, research from Bank of America found that since 1926, value investing has returned an astounding 1,344,600% compared to 626,600% for growth investing. Yes, value stocks didn't perform as well as growth stocks in the last decade. But the truth is, there will always be periods when value investing underperforms. Patience is key, and long-term results often favor value investors. Some of the most successful investors in history are value investors. Think Warren Buffett, a student of Benjamin Graham, or Charlie Munger, Seth Klarman, and John Templeton. These investors have all made fortunes by sticking to the principles of value investing and refusing to be swayed by short-term market trends. If you're interested in value investing, there are some key principles to keep in mind. Let's go over 10 important rules that every value investor should know. The first rule is simple: only invest in businesses you understand. Peter Lynch, another legendary investor, emphasized this concept. Warren Buffett calls it staying within your circle of competence. When you understand a business, you're more likely to hold on to it during tough times and make better decisions overall. The second rule is crucial: always invest with a margin of safety. This means buying stocks that trade at a price significantly below their intrinsic value. If the stock's market price is $65 and its fair value is $90, that's a solid margin of safety. This cushion protects you if things don't go as planned. Rule number 3, think like a business owner. When you invest in stocks, you're essentially buying a piece of the company. Ask yourself, would you buy and sell a business daily to make a quick profit? Probably not. Value investors understand that wealth builds over time. Rule number 4, invest for the long term. Investing for the long term is critical. The best companies grow their earnings over time, which drives up their stock prices. By holding on to quality stocks for the long run, you can benefit from compounding returns, especially if you're reinvesting dividends. Rule 5 is simple: do your own homework. Don't just rely on tips or trends. Put in the research to understand a company's financials, strengths, and potential risks. This due diligence will pay off in the long run. Rule number 6, don't follow the crowd. Just because a stock is popular doesn't mean it's a good investment. For instance, think about the GameStop frenzy. Many who jumped on that hype train lost money. Be wary of herd mentality, and make decisions based on your own research. Rule number 7, always keep some cash in reserve. You never know when an amazing investment opportunity will pop up, so having cash on hand allows you to jump on deals without selling other investments. Rule number 8, keep emotions out of your decisions. The market doesn't care about your feelings. Making emotional decisions often leads to buying high and selling low, which is the opposite of what we want as value investors. Stick to facts and rational analysis. Rule number 9, only invest in high-quality companies. Look for companies with strong fundamentals. Even if a stock is cheap, it's only worth buying if the company has solid prospects. Quality businesses tend to weather economic downturns and grow steadily over time. Finally, rule number 10, be patient. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." Value investing is about building wealth over time, not overnight. There you have it, an introduction to value investing and the essential rules to keep in mind. If you're serious about growing your wealth and are willing to put in the time, value investing can be a powerful strategy. Remember, patience, research, and discipline are your best tools. If you enjoyed this video, check out the other videos on our channel to deepen your understanding of investing and wealth building strategies. Thanks for watching, and we'll see you in the next one.